Hello and welcome. Good to see everybody trickling in now. My name is Jonathan Aiken from the Radius Plus team, and welcome to the second iteration of the Radius Plus Home Hangout. We are super excited to be hosting this again. We hosted the first one 4 weeks ago or so, and it was fantastic. We got a lot of great feedback from everybody, and we're excited to be at it again, chatting about self-storage and here to deliver some great insights and data. We, from the Radius team, you have myself, Jonathan Aiken. You also have Mr. Tao Zhao, James McLean, Corey Sylvester, and James DeGorder. All of us are broadcasting live right now from our respective homes in the New York City tri-state area. Corey, I think, is a little bit north of us in Connecticut. We have a beautiful rainy day. It is 12 p.m., April 30th. So happy to see everybody. Hoping that other people from different zip codes have better weather luck than we do right now. But yeah, we're excited. So we did get a lot of good feedback last time we hosted this. I think today we're going to pivot a little bit and talk more about market fundamentals, which is going to be great. I do want to encourage anybody throughout the entire call to use the chat functionality within Zoom. Definitely encourage this to be like an open casual forum. So definitely submit questions, comments. If you want to share, a related experience or anything, I also suggest you just flip the video on and feel free to engage directly. Cool. So without further ado, let's hand it over to James DeGorder.
All right, thanks everyone for joining us. I think we're gonna put a little bit more of a market fundamental spin on the conversation today, but want to leave it open to discussion and questions. So not too much structure, but I was just going to kick it off with I'll share my screen here, and we will take a look at, if I'm doing this correctly. If I'm not, someone on the team will hopefully let me know here. But
looking good.
Just talk about the supply-demand fundamentals and what we're seeing sort of in real time. We track rental rates on a daily basis, and this is very helpful for giving you that real-time snapshot for the supply-demand balance. And as many of you know, we've seen some weakness in the rental rates over the last 2-3 years, driven by increase in supply. We've been going through a development cycle, has put some pressure on the rates, and what we're seeing over the last month now, due to the coronavirus, is a demand-driven softness. So up in the top right, we're looking at the average price per square foot of across the entire portfolio of the 4 largest publicly traded REITs, and as you can see, that over the last year, the trend is generally lower. In the bottom right, you'll see that year-over-year change in price is roughly 20 to 25% negative across their portfolio. This is on the front end web rate, which is indicative of the supply-demand fundamentals here, sort of in real time. And you can see over the last month, these rates have taken a significant move lower. The chart on the bottom left is employment growth, and if we just sort of look at the national number here, has turned lower. Obviously, we're seeing a significant amount of job loss. We'll be getting the April number in a week, so this employment growth will undoubtedly go significantly lower. And for those of you that haven't been following our commentary in the past, we really like to look at employment growth as the main indicator for self-storage demand. So I have a article that we wrote here about 3 or 4 years ago, but I'll drop that in the chat so you can reference that. Certainly what we're seeing right now is demand-driven softness, and it's quite significant. Maybe I'll just sort of turn it over to Corey. I know Corey sort of dug in on some of the strategies that the public REITs have been taking in this environment, and I can sort of pull up some of that data here as he discusses those strategies and why they're being adopted.
Sure. So one of the things that we've seen, kind of bifurcated REITs versus non-REITs, is a strategy of slashing rate more aggressively by the REITs to try and collect all the demand, sop up all the demand that they possibly can. I mean, demand, generally speaking, from a lot of the data that I've seen, has, move-ins, move-outs obviously gone down pretty precipitously. But what you've seen, from instance, for Extra Space at some of their facilities, is that their web rates are now 50% of what their in-store rates are. And I can only guess as to, obviously they're probably not having a lot of walk-in customers or customers at this point, with how much move-ins have come down. So they're probably trying to just sop up all the demand that's available, and then they'll hit these customers with a rate increase probably sometimes thereafter to make up for that more aggressive introductory rate.
Corey, if I could jump in, we can actually show this. I believe we can visualize this, but you'll see this. We're looking at the web rate right near the green line is for Extra Space. You can see, recently it's ticked over, but a little higher than the other competitors. If we compare that to the in-store rate, if this will load here for us, you'll see a significant strategy difference. Should have had that loading prior, but
I'll just take a second to load. But it's not just Extra Space. I mean, you see something similar with CubeSmart as it relates to they've kind of have. It depends on which store you're looking at, but they have a strategy into which the web is 50% of up to 50% of in-store, or they'll give you a free month free if you take the full in-store. So. First question was, do you track move and move out data? I just saw that. But people are moving out, increases to existing customers. Brian, we don't have store by store data from that standpoint. This is something that we've kind of pieced together through talking through with multiple people, and also just looking at what the offerings look like on the pages and through the data that we have. Let's see. So James, as you can see there, the in-store rate that James just pulled up is close to all-time highs for the period that we have here. So they're cutting web aggressively. If anything, in-store rates have gone up. Now you can see here, that's Publix in-store rate has dropped pretty aggressively. So very different strategies from each of the REITs, but what they're ultimately trying to do right now, it seems like, is really be more aggressive on rate discounts in this period, which I would assume that they're just planning on making up with rental rate increases, in some sort of increment after the movement has occurred. One of the things, going back to performance, and maybe James, while I'm talking, you can just pull up Las Vegas, is when we think about COVID, personally, this could be flawed logic, but when we're thinking about COVID as it relates to how this is going to impact the industry, Vegas, in my mind, and again, this could be an incorrect assumption, but Vegas, in my mind, being as directly impacted by hotel, leisure, entertainment, that is, for me, is kind of the canary in the coal mine to a certain extent as it relates to how is storage faring during all this. I mean, we're kind of in an unprecedented situation. Obviously, employment is something we look at, but when employment goes from 3% unemployment to 20%, we have to kind of figure out, a different indicator. So with Vegas, I had was able to get a hold of some stats on delinquencies. And normally delinquencies are 2 to 3%. You normally get about half of that back in their accounts whole, and then you sell the other half with auctions. And what I can tell from Vegas is that delinquencies have only risen to about 6 to 8%, which is, if you assume half of those similar to what normally happens, if half of those write their accounts, then net write-offs should only go up by a few percentage points. So obviously we're still early in the cycle, but I thought to the extent that Vegas is getting hit, that's probably going to be one of the worst hit areas. It may not be technically the worst hit area, but it's going to be indicative of such. And if we take a look at the spot pricing, even James, you can kind of, I have trouble seeing the year over year, but what do we see with regards to the spot rates?
Well, the spot rates generally aren't too bad. Down roughly 10% in the region, so faring a little bit better than the rest of the country right now. But you can imagine you're going to see continued weakness here with things generally softening in the region. They've seen some fairly strong employment growth over the last year or two, so there might be some residual effect of that. Is why they're seeing the outperformance generally.
Yeah. Generally speaking, I kind of think, and it's too early to be celebrating, but I think the fact that Vegas is holding in there so well at this point, obviously we're still early, but it's encouraging for me to see kind of the hardest hit region doing so well in terms of delinquencies and rental rates. So once we open back up for business, obviously then we'll really see what happens. But for me, that was kind of, how can I figure out how bad it potentially is? And with Vegas, it doesn't seem at this point to be catastrophic. So I think indicative of how everyone tends to feel about self-storage, it seems to be doing really well.
We got a question here on life storage compared to the others. This is primarily due to the geographic exposure. Life storage generally has exposure in markets with lower rates structurally. So that could be Houston, Buffalo, for example, as opposed to public storage with high concentration in San Francisco and LA. So that's the reason for their lower average price per square foot.
Yeah. Okay. Yes. Okay. So I'll give you a little bit beyond that in terms of what I've been hearing on the debt market side. Banks are, for all intents and purposes, shut down during this period. That doesn't mean that they're unable to lend. It's just, I think the willingness to extend yourself during this period is close to zero with as much uncertainty as there is.
So that's a little bit of a change in view from about 4 weeks ago when you were sort of comparing this to the 2008-9 crisis where banks were unable to lend. Your sort of view was that this probably wouldn't be as bad because their balance sheets are strong. So even though they're strong, they're still not lending. Is that what you're saying?
I would that is all correct. I don't think there's anything changed from the original view. I think the view is that once the hurricane passes, then they can at least have their footing. But with regard, and I think the capital positions of the bank, generally speaking, banks are generally speaking pretty good. A lot of the mortgage debt that is held on a lot of the assets that are going to get hit really hard is in the CMBS world. So I don't think there's as much exposure to bank balance sheets. So I think they'll still have the ability to lend. They still have the ability to lend. But in regard to their willingness to do so, I don't think any credit officer, even if he has, a ton of excess capital, is going to be interested in stepping out and making a loan when there's just a lot of questions. There's more downside in making that loan than there is upside.
Yeah. So obviously there's a lot of projects that have broken ground and stuff, but as we look a year out, 18 months, you got to imagine that this is a positive for existing self-storage assets as this development cycle not necessarily comes skidding to a halt, but it's going to, further put the brakes on it as it peaked as it's been peaking over the last 12 months and starting to slow down anyway.
Yeah. I mean, I'm back and forth on certain pieces of that. I think most certainly it's going to take a lot of weak hands out of the market in terms of they probably didn't have strong sites to begin with. So maybe this is just the nail in the coffin. But the other end of that, I think storage is going to do really well through this, and I think there's going to be a lot of capital that's going to be fleeing other asset classes that potentially could make its way into storage. So while I would say, some people have told me this is the end of this development cycle, I don't know if it's going to go away as quickly as some people think, but it's definitely going to take a step down. So we'll just have to see how it plays out once the banks open back up. But in the CMBS markets, I heard that they were able to they were pricing up a package to basically take a lot of the inventory that was already on bank balance sheets and clear that through, which doesn't mean CMBS markets are back open, but it's an encouraging sign to see that there's some activity. There was some activity in that part of the market. So, I think that markets generally are okay. No one's really taking any risk, which is why you're not seeing a ton of activity. But I think consistent with last time, banks are still in much better spot than they were last cycle. Let's see what else.
What do you think, just given sort of a relative, obviously storage is seeing some pain right now relative to other real estate asset classes. I know we were talking a little bit, maybe, clearly like malls are having a rough go. A lot of money's been flocking to self-storage over the last several years as it's sort of become an institutional asset class. Do you think that if there's overall softness in real estate, the money coming into self-storage is going to continue as aggressively, more aggressively? Any thoughts on that?
I think there's so much capital on the sidelines still that inevitably there'll still be a lot of capital available to self-storage. If we looked at just the performance, I was pulling this up. Besides data center and infrastructure, last time I pulled the stats from NAREIT, self-storage is the third best performing asset class behind data centers and infrastructure. So, obviously we're about ready to get all the conference calls, so we'll hear a little bit more on the ground fundamental view, but certainly the way the markets are pricing it right now, I think there's still a lot of interest for self-storage, certainly relative to other asset classes. But yeah, we really need things to open back up, see how the market clears out, because a lot of people aren't paying rents at these strip malls, and what's going to happen there, and how much flow through to the rest of the economies is actually going to have. So I think we still have some questions out there, but there's going to be a lot of capital that goes into storage.
Yeah, go ahead.
Hey guys, how are you?
Good, thanks.
Brian?
Is there any data in the self-storage industry related to collecting rent like there is in multifamily? One of my buddies here works in structured finance, and they're tracking massive portfolios in multifamily and in the different sort of class types as well. And even though I've read like mid-90s collection rate in like Class A in Southern California, it's like 88% are collecting rent in multifamily. Do we have any data in the self-storage like that?
So we wouldn't have data like that. What stat I got from each individual operator is going to know what the delinquencies look like on their book and what the net write-ups look like after cures and auctions. And so that was so to answer your question, that's all the insight we have. I mean, that's why we got the data from Las Vegas, which shows that delinquencies are up from 2 to 3% to like 8%. But in terms of tracking that more broadly, we don't do that. No, that's something that each company has and is private to their own domain.
Sure, but I would agree with you on the Nevada, particularly the Vegas front. I mean, that market is hit pretty dang hard, and if their peak is right now anyway, like you said, it's early 8%. That's a pretty good indication that it's not so bad.
It is. I mean, it's also the private REITs have most of those guys set up on credit card auto pay, so they're probably the best of where it's at now. Some of the private operators that don't have their guys set up on auto pay, I bet you it's going to look a lot more painful. But that's more of a lesson of transitioning from a mom and pop industry to a REIT industry, to a more institutional industry. So more reason why you want to bring those practices up to speed.
Yeah, that's an interesting thought, because there's so many markets out there that I've been to. I'm sure you all have been to that. Compared to a Southern California, I feel like they're 20 years behind. So those markets are probably going to be more susceptible to those delinquencies if they're not set up in the modern world here.
For sure. Yeah, I posted something on LinkedIn a couple months ago about how self-storage is recession resistant. And I got a lot of kickback in the comments from a couple people that said that their occupancies went to drop like 30 or 40%. So what I'm trying to be conscious of is that while REITs are a good indicator for the industry, there's still a lot of people out there that are going to have different results because they're just not operating on that same institutional level. So, yeah, that's the one caveat with that Vegas stat, I guess. But yeah, no, that's a good question.
I'm curious what people are seeing in terms of, there's probably still not very much activity on this, but where these self-storage leased up assets are trading. If there's been any sort of change in seller expectations, a little bit more realistic. I've got the cap rate chart here for the publics. We've seen, about 80 to 100 basis points sort of, they've settled in. Certainly the cap rates on these publics have, expanded a little bit. Curious if anyone has seen a change in seller expectations or any transactions that are being negotiated now. I guess anything that's closing now is probably not very indicative of the market, but.
Yeah, we do have the broker of the year, Aaron Swerdlin, on the conference, but he may be in his boxers, not willing to share his video. He would be the one to have the best view there. But I know that people have reached out to us with C of O portfolios wanting to find buyers, rather in a significant way. I'm not sure if that's
C of O portfolios, meaning that.
Yeah, so they built assets. They built assets in 2015, 2016, 2017, and those are in various stages of lease up. And for whatever reason, they're now interested in unloading those, which I think is happening more broadly. But from what I gather, expectations are still, at least on the couple that we were helping the owners with, it seems like expectations are still far apart.
Hey, Corey and James, it's Aaron.
There he is.
Hey, Aaron.
Appreciate the overinflated description. I think you're right. Until something comes to market and prices in the current environment, anything that's closed is kind of pre-disruption metrics. I think we've closed about $170 million since March 13th, and none of that's indicative of current pricing. Is indicative of the strength of the product type, because nobody tried to retrade or back out, even though certainly the validity to doing so is accelerated every day since. But it just seems to us like cash flow is going to continue to be worth maybe even more. I don't think it's out of the question in the top 15 or 20 MSAs to see cap rates compress a little bit for stable stuff. It's going to be all contingent upon how May and maybe June wind up for collections. So far with nearly half the industry on anniversary date, we were already getting a view into the May rent cycle, and everything we're hearing is collections are extremely stable. Some of the kind of mid-size operators with 50 to 100 properties are even going so far as to project Q2 as being flat year over year. So, they might be with a little bit of elevated occupancy, but if they're able to produce the same revenue as last year, that's going to bode really well for the industry.
Yeah.
Problem is sellers have no, what's their data point for taking a price reduction with outsized performance on a relative basis? Why would you? Where are you going to put your capital once you do monetize? Because it seems like storage is already, the best or one of the best places to be.
So you think sellers will remain? I mean, it's sort of it's a general theme, but seller expectations have been, it's been tough to clear because they've been, I guess, I don't know if unrealistic is the right term, but it's a little bit of a generalization. But you sort of think that continues. You don't expect that sellers becomes sort of more aggressive in this, meaningfully more aggressive in this environment. What you're seeing now.
No, I mean, I think if anything, this is going to bolster their position. The storage is great. Why would I take a discount? I do think lease up stuff. I mean, we've been saying for a while now, street rates really mean nothing to stabilized operators. They mean everything to CO and lease up operators.
Yep.
I think you're going to definitely see a divergence of the market between two. You're going to see lease up properties. You're going to see stabilized. Stabilized, I don't suspect values are going to change that much. I think you'll find capital trying to find its way in, and probably be any adjustment to pricing will be entirely operations driven and not return expectation driven.
Right.
Lease up stuff, hold on. Some folks are in for a heavy experience if they've got a lease up portfolio.
Yeah. So sometimes in times of sort of macro dislocation like this, you'll have underperforming sometimes you'll have to sell your best assets to go fund your really underperforming assets, sort of a little bit of a liquidity crunch to some degree. You aren't seeing anything in the market where these funds are, sort of having to come to market with storage to, perhaps fund
Not yet.
else.
Not yet. I mean, during the GFC, the redemptions really drove the sale of the better assets because it was the only thing in which you had equity and could sell to meet redemption because for a lot of the funds, I mean, if people want their money back and you can't give it to them, your ability to raise money going forward is, zilch. And the places where you had the most equity were your better performing assets. This time, I think most lenders, if it's going to be a lender-driven issue, they've got much bigger challenges with other product types than they do self-storage. With the exception of 2 or 3 developers out there, you really don't have a concentration of development risk in any one place. It's very fragmented across lenders, very fragmented across operators. So, I don't see, unless you got a recourse issue or something that's, really driving the motivation to liquidate better assets. Why is somebody that's got good, stable, cash flowing assets kind of get rid of that to save a loss leader that, really there's no end in sight to what's going to happen with street rates? The stuff you guys just talked about with what Extra Space is doing with rates, I mean, we're seeing it kind of across the board in certain markets. Street rates are challenged, but they don't mean anything. If you're 90% occupied, you have, 8% of your facility turning over in any given month. And you've got all these cohorts of tenants you could put existing rate increases on once the market kind of opens back up. It's going to be a tale of two markets, lease up and stabilize.
Yeah. Well, that was awesome. Thank you, Aaron. Anybody with any other questions out there? That's kind of all I had from my standpoint. I don't want to jump.
I got another question here.
Go for it.
I got a couple. If there's people out there that want to chime in on this theme of the tale of two markets, my sort of view on these C of O deals ever being really an opportunity if things got bad, which there's starting to, that the public REITs would be best positioned to sort of step in and take advantage of the opportunity if it existed, just given that they're doing the third party management and have got wide breadth across the market. I guess the question is there opportunity for self-storage investors generally to participate in some of these distressed C of O assets, or is that just the public REITs?
Yeah, I would actually be interested in Aaron's answer on that one. they do exchange sometimes stock for, or OP units for the sale of these, and obviously the stocks are taking a little bit of a hit, but they're still pretty done pretty well, relatively speaking. There he is.
Yeah, I mean, you got to imagine the REITs are so much better capitalized this time than last time. I mean, for everybody see names on the call here that were definitely, just as active in 08 and 09. And we remember, I mean, of the what, 4 publicly traded REITs at the time, 2 of them, I believe, were literally some of the bottom 5 weakest balance sheets across the entire REIT universe. This time, not only are the REITs overall significantly better capitalized, but storage in particular is, far less leverage. They've got access to capital. There's certainly not a huge motivation to dilute existing shareholders by doing large equity raises at current stock prices, but for the right opportunities, I mean, none of them have debt maturity issues anytime in the next 12 months. So it's not like they got to raise equity to pay down debt, or, they've got plenty of capacity on revolvers. And because we don't think there's going to be systemic, just, huge swaths of opportunity, I don't think there's going to be, hundreds of millions of dollars in one fell swoop worth of default that needs to be cleared anyway. I think it will be tough to compete with the REITs for the stuff that they want to own, but there's going to be plenty of stuff that I think they feel is, should have never been built in the first place. And there's going to need to be a lot more pain before the basis is right sized to, where you would have to be on rental rates to make it make sense. So I think they'll be tough to compete with, but at the same time, there's never been more non-public equity capital trying to find its way into the space, and they'll be just as competitive. So there's going to be significantly more capital than there are deals, especially distressed deals, unless we take huge legs down as a sector. And as you guys have pointed out on the kind of the early prints on data, it just doesn't look likely that happens. Or if it does, it means everything else is still so much worse that storage is still going to fare positively on a relative basis. Right now, we're faring very well on an absolute basis and a relative basis. If that continues, there'll be enough capital to swallow all the deals from a distress standpoint.
Yeah, I agree.
Hey, Corey, this is Michael. Wonder if I could add a follow-up to Aaron's comment, and that is that I've been surprised over the last couple of years seeing how many regional and local developers were actually backed by large equity. And so maybe that's a bit of a different angle this cycle versus last cycle, but a lot of folks thinking that there will be tons of great deals to buy. They've already been boxed out by the current owner that's in there, who are themselves a big equity player, big equity provider, and will themselves be working that deal out. And if, they'll have their own access to options that the developer himself wouldn't in ordinary circumstances. So sort of a rider to Aaron's point.
Yeah, that's a great point, and that highlights that there's been a lot of people talk about the opportunities in CO, but what you're saying is that the institutional players that originally built these facilities are just going to put in more equity or work out the situations versus losing an asset that everybody at this point knows is a very valuable asset. Yeah. So the incentives are the balance sheets are a lot different, being able to hold on to those versus having to dispose of them.
Yeah, you could see if a particular equity provider started having major global issues and they wanted to unload, then you would see maybe a group come to market at once, or they would, that I think is a potential depending on how other sectors that equity provider is in treating their overall portfolio. That to me is one potential war game outcome here. But just to think that there's going to be all these regional and local developers that are going under, there will be some, but so many of them ended up getting access to major private equity this time around that there's that dynamic that maybe didn't exist quite as much 10 years ago.
Yeah, that's a good point. So when are the banks opening up their lending?
Well, Corey's giving away the fact that I'm a banker. So, we have to figure out what our losses will be right now. And I was telling Corey on the side in chat that every $10 of loans that we put out is $1 of capital that we have to hold. But every $1 that we lose on a loan then takes away our ability to do $10 of loans. So we need to figure out as an industry how deep and how wide this is, and how much, like, so the banks are well capitalized. I work for TCF Bank, for those that don't know. We are even higher. We even have a higher capital ratio than our peers. We're about 11% capital. But if we chew up 2 or 3% of that dealing with losses, and you multiply that into how much in new loans that would mean, you're talking, maybe several $billion. So right now, our budget for new loan origination, the other thing we're being impacted by is lack of payoffs.
Yeah.
So we would ordinarily see a cycle to our portfolio that would allow us to take on new originations to replace what was leaving, but now loans aren't leaving. And while in some cases that's good, in some cases that's not, we don't have that. We have to watch that ratio of capital to loans. And if this is not shrinking, then we can't replace it. And if this has to be here, then we don't have as much flexibility here. So we are in solid shape with what we have, but to add new is where our difficulty is. We just don't have the bandwidth to do that until we know how much this will end up being.
Right.
So very difficult. Because I see lots of opportunities right now, but I can't really take advantage of them the way we'd like to.
Yeah.
How long do you think it'll take to get some visibility on that? Obviously it's impossible to say, but when are you thinking you will have better visibility in terms of how your portfolio is performing and what your appetite is for?
Yeah, that is a really hard one to say, and I don't want to characterize it too much, but I believe as we watch this economy reopen, we'll all see how companies and businesses are responding. All these banks, all of us banks, we have real estate, but what we aren't thinking about maybe within a real estate group is all of the businesses, right? We call it C&I in banking, but commercial, industrial, but all those businesses are tenants of warehouses and tenants of offices and whatnot, and we have lent to them, and so their ability to generate revenue and to pay their loans. It's not just like, I can have an understanding of what's going to happen in storage. It ripples through the balance sheet. This pandemic effect it's widespread in its impact. So you could think to yourself, as soon as we reopen, we should know within 90 days. But if the pace of that reopen is slow, then that goes out the window.
Yeah, that's a good point. So it's gonna take some time to really understand what loan losses look like, because you don't know whether something's performing even 90 days into it, because they don't know what to expect from their own revenue standpoint. And
if we reopen and then 90 days into a reopen, a company's revenue has returned to 80% of what it was, that still isn't likely good enough. So how long will it take for them to get to a point where they can service all of the capital obligations they have and get back to profitability? That's the big unknown for us. And and thankfully, in storage we don't have quite that pressure, but the hotel group, those hotel businesses, how quickly will we all go back to staying at hotels and traveling on a widespread basis? That's a good question.
Yeah. Aaron asked, there's a discussion around establishing a bad loan balance sheet to transfer problem loans to keep lending fluid for strong merit deals. So that kind of the goal of that would be to reduce the zombie bank environment, which after in the early 90s, that was what was created. And there was some stuff, I think, but essentially the Fed could probably just buy all that stuff. That would be a great idea. Michael, I don't know if you have any ideas around that, but that.
I haven't heard anything to that effect yet. It's funny because things have moved so fast. We're only 6 weeks into this mess. They probably need time to assess some things. But you know, they didn't do that 10 years ago. I would have liked to have seen them do that 10 years ago, because I think bank behavior would have been a lot different in 2010, 2011, 2012 if there had been a bad bank type mindset. But they didn't do that. They plugged the balance sheets and of the banks, and then forced us to deal with troubled assets. TDR became a swear word and whatnot. So the last war that was fought, they didn't go that route. So will they change? Will the Fed and other policymakers shift course and go the bad loan balance sheet route this time around? That remains to be seen. But that's not what they did the last time around.
Yeah, there was a lot of hostility towards the lending institutions as it relates to the last crisis. So there was probably, from my former life, know that there were some issues around the idea of buying these assets off of the banks, and the banks potentially being able to skirt by without any issues. So they just plugged their capital. Yeah. All right. That was awesome. Anybody else have any other questions?
I got another one if there's.
Shoot, James.
In this COVID environment, how important is it for operators to have a touchless experience or a completely digital experience, whether it's just strictly through your smartphone or what have you? We've seen a number of announcements from some of the operators. How much attention is going towards this, and is it almost an essential way to really be operating in this environment?
Are there any operators on the line? Yeah, I don't think we have any.
I mean, it's certainly interesting to see from a point of focus for from mom and pops to larger REITs. Everybody's sort of on the same page in that conversation, and I think in the public eye, they're making it a point to be contactless, emphasizing online reservations, online everything, online, handling your finances online. And then there's also like the on-site kiosks and things. So even if it's not 100% contactless, just being humanless, I've seen that starting to be like a big focus in press releases and things.
Got to make sure those are washed down though.
We do have another question here. I just want to make sure. Do we address Brian's question? Budget for Newlands today. What would the typical budget be for non-COVID? Just want to make sure that we address that one before we mosey.
Yeah, this is Michael. I think he was coming back to the banks on that. What would we be ordinarily wanting to originate versus what we would now be able to originate? Generally, and this is different for every bank because everybody has a balance sheet that is somewhat different. But for instance, Wells Fargo's balance sheet is only half loans. I don't know if you know that or not. They have so many assets. It's like a little bit over its half loans. The smaller banks have a larger ratio of loans, so it doesn't quite apply. But generally, a bank's loan portfolio will pay down 15% a year, rougher, plus or minus. And they generally are wanting to grow 5 to 10% a year. So if the 15% isn't happening and you're preserving on the 5 to 10%, then take a bank that has $100 billion worth of loans, and that's $20 to $25 billion of loans that they would ordinarily be doing in a year. And now that is shrinking very dramatically. That's, and then ripple that across all the organizations, all the banks. So it's a lot of capital that is not being cycled. It's not being made back available.
Mm-hmm. That's interesting.
You guys hear me?
I hear you, Chris.
Yeah. Hi, how you doing? Yeah. I just had a comment as an operator. People were asking about the contactless or touchless experience, and that's something that we had been looking at for a while before this happened, of trying to understand how online and how fluid we could make that rental process for customers. So that's been something we're focused on. We're actually launching our new website tomorrow. So kind of the timing worked out. It's been about 7 months since we started our transition of website from automated to the storage group, in an effort to make that experience as online and as smooth as possible. Today, we've put in protocols at our stores in Massachusetts and New Hampshire to essentially have one person in the office at a time. So these sort of protocols to appease folks as it relates to COVID. But the hope is we'll get through this. We'll give them that experience of whether it's on phone. We actually set up our call center a few months ago as well, which is new for us. We have 8, soon to be 10 locations, but so set up the call center, have the website going, and this is all meant to help that contactless experience today as it relates to COVID. But there's no question that we want to, if someone wants to come in or talk on the phone, that's totally fine. We'll obviously still capture those customers, but in my mind, we should be focusing on making sure the online experience is as smooth as possible. And even, they actually rolled out this week, the storage group did, the ability to buy merchandise online now, which I know they've been working on. And I think there's a larger play there for them to try to get that, like, to be you'll be getting these supplies from elsewhere, but for right now, what it's good for is all of the supplies that we currently have in our stores. It's just sitting on the wall. We're not creating any revenue because nobody's coming inside. So they have the ability now, once we launch this, for folks to make their reservations online, pay online, sign the lease online, buy the supplies online. They show up to our store. If they ordered boxes, tape, locks, whatever, it's all in the unit. And so it's completely seen. And now, like, this is great for COVID, but in my mind, this is how it should kind of be anyway. And so, I don't think that REITs will ever go the full automated way, obviously. So, like, as an industry whole, it may not go there, but for us as a local operator with a dozen stores or so, it makes a lot of sense to me. So we are very focused on doing that.
Yeah, that's great commentary. I don't know. Yeah, I've had questions about people. Why don't they go fully automated? And I guess the other piece of that is that I've heard from them is that the person in the office is a salesperson, and being able to sell tenant insurance has much more upside than completely removing them from the cost structure.
Yeah, and that's what one of my understandings about the REITs anyway is that the insurance is such a profit center for them that to go without without your sales rep in there would be forfeiting a lot of money. Plus, for some of them, or maybe, I don't know about all of them, but for some of them, it is their own insurance. So they're keeping 100% of what they're making on it. So, like, to forfeit that would be foolish. Though, it seems like there should be a way to figure that out. I don't know, without having to have a person sitting behind a desk to do that anyway. But, again, we're too.
What have you seen for move in and move out trends, generally speaking, across your portfolio?
So we have seen a decrease, I would say, in activity, but we're not. I mean, what we did see, sort of nuance, obviously, was at our Boston proper location. We had a ton of move-ins, like way above average in mid to late March, and then a handful of above average move-outs shortly after, like April 1st kind of thing. So obviously with students, but no, we've seen a little bit of I would just say decrease in velocity. So lower move-ins, but lower move-outs as well. So our net effect hasn't really been that bad. Our delinquencies are only up by a little bit. I forget who was talking about it, but our average across the portfolio is in like that high 2 or 3% range. We've had a few, last month that were like in the 6% range, 6.25%. So you're keeping an eye on it, but like, it shouldn't be surprising. I was just talking to our head of operations today, and we're looking forward to tomorrow. One of the things that we want to keep an eye on is for those people that are on auto pay, did they actually take the steps to remove themselves, or is it the folks that are sending in the checks that are not paying? So we'll find that out tomorrow.
That's a great question. That was my next question: is how many of your how much of your portfolio is auto pay?
Yeah, I honestly don't know. I think based on what I was talking to Steve about, I can't even give you a data point, to be honest. I know that we've been making a push to, not force, but strongly suggest that people get on it. But I don't have a number, unfortunately.
Yeah.
But we have the other point that we were talking about, and I think you guys mentioned it, was the internet traffic just really hasn't slowed for us. So what we were just talking about this morning was like, do we think there's going to be a complete loss of a rental season, a slower, a delayed rental season, or a delayed rental season and shorter, meaning like it starts in whatever it is, July, and it still ends in that sort of September timeframe. But what's uplifting is that our internet hits have remained pretty close to what they've been historically. So, and now it's been 6-7 weeks, and anytime we have sort of this big uptick in move-ins, we're talking to our managers asking why, and it seems like it's folks that this was what they were planning on doing once sort of spring hit, and then COVID hit, but like there's still a need for it, so they're waiting, and then it gets to a point where they're like, we need to make a decision, and
yeah, true pent-up demand.
Well, that's exactly what I said. It's like this was literally just completely pent-up demand once this release.
We've talked about pent-up demand previously, and how this is obviously a unique situation where there quite literally could be very much pent-up demand because you've been strapped by a leash to your home.
Yeah. So.
Well, that's awesome, Chris. Thank you very much for dropping in with those insights there. That was great. James, any other questions?
Casey's got a question on some of the rates. I guess noticing that the REITs are dropping rates, but not all operators, and wondering if perhaps the Northeast is doing a little bit worse, just given greater lockdown there. And I think generally we sort of started the conversation talking about how the strategy the REITs were taking was quite aggressive. So we are seeing the REITs be more aggressive on rate across the country versus some of the private operators are really trying to soak up any of that demand that is out there. So that is definitely a trend that we're seeing. In terms of the regional analysis, I've got the top 25 markets up here. You'll see that the West Coast and the Northeast are, continue to perform quite well relatively, despite some of the more aggressive lockdowns. So what I would say is that we're seeing broad-based move-in rates, not necessarily regions that are primarily affected by COVID, if that makes sense.
Awesome. And the data that James is displaying right here, if you want to just message any one of us, we can help you. We can help make sure you have the right tools and credentials to be able to access, so you can review at your leisure. But definitely welcome any more questions as I ramble for a second. I think we're about closing in on the 60-minute mark. Really appreciate everybody coming on. Really appreciate all the conversations and questions, as well as commentary. I think as we are seeing history unfold in front of us, it definitely is more and more interesting to host these hangouts regularly, just so we can glean some variation in even the topics that we continue to talk about from session to session. So, excited to see what we may chat about in our next one. But in the meantime, thank you everybody for participating. We'll be circulating, a review of what we chatted about in the near future. And as well as some video elements as well.
Yeah, and just wanted to chime in to the extent that do you have feedback and want to hear more of one thing or topics or anything, we're always ears and want to improve. So if you've got any suggestions for the next go around, please let us know.
Does anybody have, are there any operators or whoever, research folks or whatever in the Georgia state market? I know that they were supposed to reopen, I think it was on Friday. I don't know if that was last Friday or this Friday, but I'm curious to know if there's been any, and I think actually Texas to a certain extent had is that true, Aaron? Is Texas open up parts of business again? I know the Northeast is we're very much still on lockdown, so I don't.
Texas specific businesses are opening tomorrow, and then the second phase is I think the 18th after a reassessment on how this first wave goes and what does open where there's customer count. It's at 25% capacity.
Oh, that's right. Yeah.
So I mean, I don't know. It's kind of bumping around in a room with their eyes closed and figuring it out. It's nobody really knows what's going on. It's kind of a shit show.
Yeah. Yeah.
I'm
curious if there's stats to take from the states that do open and see if there's any takeaways from those, but that'll require weeks of data anyway. So
yeah, for example, here's Atlanta. I mean, it's skewed a little bit because Space is just taking this national strategy here on the web rate in the last couple of days. So maybe there's a little bit of uptick in the last few days from public storage. I don't know if that probably too early to say that's due to the reopening at this point.
Yeah. All right, good stuff. Well, yeah, like Jonathan said, thanks for joining us. Always reach out if you want one thing over the other in terms of what we're talking about. But Aaron, Chris, Michael, thank you guys for chiming in and all the questions, and we'll do this again soon.
Yeah.
Thanks, guys.
All right.
Stay well, everybody.
That's right.